Yeah, welcome everybody. Thank you so much for inviting us. We're ConsciousGrowth, and we're the first European provider of revenue-based financing. What that means is we give financings and receive a share in future revenues, all without diluting in equity, giving personal guarantees, or giving up board seats. With that, we're trying to solve the following problem. If you have repeatable, predictable growth as a company, currently the only way to fund that growth is via equity or venture debt. And as you can see, and as I'm sure everyone knows, there are some pitfalls with both equity as well as venture debt. With equity, it takes a long time to raise the money. You give up significant control over your company. The money is usually the most expensive money within your financing stack. And as I said, it takes a long time. It is a big distraction. Venture debt is usually goes along similar lines. It's quite expensive, especially if you count in the warrants and equity kickers. You give up control in the form of guarantees, and it takes a long time to raise that money. As an example for how expensive equity can become is here the example of Uber, where 100,000 invested during this time of Series A in Uber. That 100,000 is now worth more than 4 million. Similar goes for venture debt. Venture debt can become very expensive when there are equity kickers, warrants. They often also have something called MAC clauses, which basically allows them to claw back the money in like unforeseen events. So all of these things, including the personal guarantees, are pretty scary stuff for founders. All of this has led to founders owning less and less owning less and less share of their own company. For example, Lyft, which went public earlier this year in the United States, the founders only owned about 3.5% of their own company. So the solution to this problem that we're describing is revenue-based financing, which basically funds predictable, repeatable growth. And the way it actually works is if, let's say you have an e-commerce company, you wanted 200,000 from us, you would connect your revenue, advertising, and bank accounts via API. Within 24 hours, we could let you know whether we could finance you under which terms. And then if the financing happens, from day one, a share of your revenue goes back to us until the 200,000 plus a fixed fee is paid back. The money is dispensed on a virtual debit card, so that we have oversight of the transactions and we can evaluate the risk model a bit further, and in case of any fraud or something goes really south, we can also become proactive and freeze the money. The advantages for founders are pretty clear. So you retain ownership and control over your company while not diluting in equity. That's kind of the main point. You get the money you need fast. So the whole turnaround can be within like 2-3 days of applying for capital and receiving it on the virtual debit card. You pay back based on your cash flow, which basically means if your revenue goes down, your repayments also go down. So it's very founder-friendly versus a normal loan, which is always fixed. So coming back to the initial slide, we're quite reasonably cheap compared to definitely equity and also to venture debt. Oftentimes, we're cheaper than venture debt. You don't give up any control. We don't want any board seats, no personal guarantees. And it goes very quickly. As I mentioned, 2 to 3 days and you have the money. Our target market is twofold. One is scale-ups, and then there's also a sort of long, fat tail of smaller companies. The scale-ups in Europe have collectively raised about 22 billion in equity last year. And if you conservatively count about 20% of that going into marketing, then about 4.4 billion in financing money should be financed by a different asset class than equity. And we believe revenue-based financing should be that asset class and is the future. As I mentioned, there's also the long fat tail of companies, small Shopify shops offering their products, having great unit economics, but no access to venture capital or banks. Our lending criteria are fourfold. There needs to be product market fit, good unit economics, a healthy contribution margin, and a healthy bank balance. But then even beyond that, once we've done the financings, we have still oversight of all the data. We're still connected in all the data points. We have oversight of the Wirecard transactions. Wirecard is our payment provider for the virtual debit card. We receive our money back fairly quickly. So we optimize for a payback within 6 months. So the risk decreases significantly. Quickly on our team, it's a team of finance and technology professionals from banking, finance, VC, and PE. And we're very excited to be here today. We just launched 4 weeks ago. We already did a number of financings in the last couple of weeks, and we're doing a proper equity fundraise early next year. And we're also offering a debt facility for which we're happy to have conversations. We're offering 12% return on a 12-month lockup. Thank you very much for your attention.